Hello, everybody. My name's Bernicke, and I'm going to be doing the October monthly market update for this month. And one of the questions we've been getting quite a bit lately is the stock market overvalued? So I wanted to touch on that. And when we talk about the stock market, frequently we'll talk about the S&P 500 index, which is just a collective of 500, mostly U.S. large company stocks. And one of the things you've probably heard me talk about in the past is something called the PE ratio, which stands for price divided by earnings ratio. And today I'm going to be talking about one variation of this PE ratio called the forward PE ratio. So basically, again, you divide the price of the stock by the earnings of the stock or the company to come up with the PE ratio. So if the value of the stock goes down and earnings stay stable, that PE ratio will drop. Or if the stock price stays the same and earnings go up, that PE ratio will drop. Generally speaking, if you don't understand anything that I'm saying about denominators and numerators and division and the price to earnings ratio, the one thing you need to know is that lower is typically better when we're talking about the PE ratio. The 30-year average of the S&P 500 index is 17. The current average is 22.8. So again, because it's a higher number than the historical average, historically that hasn't meant great things for the next 5 years, as we'll show in this graph right here. So the graph that you see right here, it's a scatter plot that shows the average rate of return as listed on the y-axis over here for various PE ratios in the past. So you can see over on the left, we've got low PE ratios. On the right, we have high PE ratios. On the y-axis, we've got 20% listed here. So if you see a dot at that 20%, that means that at this particular PE ratio of approximately 12, the stock market averaged the next 5 years close to 20% on average annual return. But the biggest thing that the biggest reason why I wanted to show this scatter plot is that you can see on the left-hand side here where these PE ratios are lower, you can see that the average rate of return per year for the S&P 500 index tends to be very good and many times over 20% on average per year good. But then if you go to the right here where the PE ratios are much higher, you can see that the average rate of return for the S&P 500 the next 5 years on average is close to zero, including if you look at this red diamond, which illustrates where we're currently at today with the PE ratio. So if you were to look at this in isolation, you would think, gosh, that's kind of scary because that would imply not good things going forward into the future. But the reason that we're not as concerned today as we might have been in the past with this high of a PE ratio is what I would call the big unknown, which is how much efficiency is AI or artificial intelligence going to add to corporations in the future? Because most people know that's been involved with business planning in any sort of situation that most companies' biggest expense is labor. And it's also been talked about how artificial intelligence will help many companies reduce labor, therefore reduce their biggest costs, which therefore should improve earnings. And again, if earnings improve, that helps to drop that PE ratio. So the reason I'm not as alarmed by the PE ratio today as I would have been in the past is because of the advent of artificial intelligence. If it's going to be half as big as what many people are talking about, that should improve that PE ratio and make it better for the market to be able to buck the trend of having a higher PE ratio as illustrated in that scatter plot we had just shown. But there are a few other considerations to think about too. If you look at the S&P 500 today and you just take out the 10 biggest companies and keep the remaining 490 companies in the S&P 500 index, that actually drops that PE ratio down considerably. Number one. Number two, we just talked about large company stocks as measured by the S&P 500 index. Most of you also own small company stocks and international stocks. In both small company stocks and international stocks, I would argue have more favorable PE ratios than US large company stocks today. So for all of these reasons, I wouldn't panic about the current state of the PE ratio. Certainly you can find any sort of news out there right now to justify your opinion on where the markets are, whether you think they're overvalued or undervalued. You can get any opinion you want out there, but that's our stance on things today. So we're not making any big decisions or changes with portfolios at the present time for all the reasons that I just mentioned. Hopefully I gave you an understanding of kind of where we're thinking the markets are. Of course, in this business, there are always things percolating under the surface that you can't see that could potentially come back to bite us. But at the present time, we're kind of in a pretty neutral state of mind as far as where the market is valued at. If you have any questions or concerns, please feel free to reach out to us, and hope you learned something valuable today at the monthly market update. Thank you.